U.S. Treasury yields in focus this morning as investors prepare for a week of fresh economic data that will better illustrate the state of the U.S. economy. On the docket, consumer confidence, new and pending home sales, and PCE and consumer sentiment. Joining us now with what to expect from the week ahead is Bill Adams, Comerica Bank Chief Economist. Bill, thank you so much for joining us. So first up, what would you say is the main target this week? Would it be PCE in your view?
I think that's probably what's going to be most important. That'll be both the state of the consumer with spending on services as well as goods. We haven't really seen as much service data for the month of May yet. And then on top of that, we're going to get the Fed's preferred measure of inflation.
And so is that going to come down, do you think? Are we going to be going in the right direction, not just for that data, but any other upcoming inflation data in the coming weeks?
We're in a part of the year where the inflation data is really getting graded on a curve, and it's an easy curve because the year-over-year comparison is now comparing against the spring and summer of 2022 when energy prices were surging after Russia invaded Ukraine. So something would have to go really, really wrong for inflation not to slow in the month of May in this release. I think the bigger question is going to be what happens to sticky service prices. And the Fed has said that they are concerned that those sticky service prices, that's the cost of getting a haircut, the cost of sending your kids to daycare or getting your car repaired, those are not slowing as much as energy prices or food prices. And the Fed wants to see the overall economy cooler so that we see less pricing pressure, less pricing power from businesses and less pricing pressure from wages, bringing overall inflation lower, not just this year, but next year as well.
Bill, the housing market has held up strong recently, and we have more housing data coming in this week, new home sales, et cetera. Are you expecting the housing market to remain resilient?
I think the housing market's going to be resilient in the second half of this year. And I think there's a good chance that the bottom, both for residential construction, as well as the bottom for new home sales is in. There is a big drag on home buying power from high mortgage rates at this point. But high mortgage rates also mean that a lot of people who might have downsized, might have moved, might have sold in 2023 are holding on to their 2.75% mortgage and are not putting that home on the market. And that means there's just much less supply of existing homes. And that is funneling home buyers into the newly built segment and really supporting construction and transactions in that part of the housing market.
Does that also imply, Bill, that once rates stop going up or even start to go down, that we will see more of a lift to the housing market than we would have traditionally?
Another way of thinking about it is that the Fed is going to be more reluctant to cut interest rates given how resilient housing has been. And so while I think that the Fed's next decision, probably a 0.25 percentage point hike in July, I'd say better than 50-50 that that's the last hike of this cycle. But I'm now thinking that the Fed will probably go quite slowly in 2024 in reducing interest rates. Right now, I have rate cuts penciled in only quarterly next year, so still leaving short-term rates at a relatively high level at the end of 2024. And that's different from what I was thinking 3 months ago when I thought housing was going to be more of a headwind to the economy and that headwind would last longer.
So, Bill, what other differences have changed in your view on the economic picture? From your view, are we headed to a recession still this year?
You know, I have that recession in my forecast. It's for economic forecasters, we're kind of in the extraordinary claims require extraordinary evidence at this point. And with the yield curve so inverted, you kind of have to have the extraordinary evidence that the economy wouldn't have a recession. The Fed's own, the New York Fed's forecasting model based on the yield curve has a 70% odds of a recession over the next 12 months. So to say that, the other 30% is going to come through, you need to point to something really remarkable going on in the economy now, keeping it out of recession. There are some good things happening, though. In addition to housing, you've got consumer incomes, household incomes outpacing inflation since June of last year. And the labor market in general is remarkably resilient. Labor force participation of workers under the age of 55 is at the highest in over a decade. So that side of the economy is holding up quite well. It's possible we'll dodge a recession. I think right now the central case is probably a mild pullback in activity, and we can argue over it for months and months once the data come in, whether it was just a soft patch or an actual mild recession. But I think the odds of a more serious recession seem lower than they did 6 months ago.
Bill, this week the Supreme Court is expected to rule on the Biden case involving the student loan repayment moratorium and kind of determine what happens next. If the moratorium expires as expected in September and there's no other legislation on that front, what effect is that going to have on the economy and consumer spending?
Well, people who are spending more to pay back the student loans are going to be spending less on everything else. That's obvious. But I think the question is, how does that play in the mix of other things affecting consumer spending in late 2023 and 2024? And there is a lot of support to consumer spending right now from the very solid labor market, from solid wage gains, from less inflation, gas prices down from their peaks last year, and a lot of consumers who have fixed rate mortgages, who are not exposed to the increase in housing costs, are experiencing less inflation than you see in the CPI index. So that's the support. To the downside, you have the restart of student loans, and then also these long and variable lags of monetary policy that are likely to make credit-funded parts of consumer spending, think auto sales, grow less quickly in 2024 than they otherwise might have.
All right, we'll keep an eye out for that ruling and see what happens with all these other variables for consumer spending. Bill Adams, Comerica Bank Chief Economist, thanks.